All right, folks, how you doing? Ordinary Income back today. Hope you all had a great weekend. We are back to it on this Monday, and we're starting off a little bit bleak, as you can see with this photo, because there is something that I've been seeing going around last week, all based on a few metrics that came out. So a lot of people are talking about, are we going to be having a recession coming up? Are we in the midst of one? Is it happening right now? The reason in particular is because we had our GDP number come out, and the GDP contracted by 0.4% of Q1 of 2022, meaning we had a growth rate of negative 1.4% on the annual basis. So we're declining at a negative 1.4% because we contracted by 0.4%. All these numbers pretty much mean that we had a worse quarter by GDP standards in Q1 of 2022. And how bad was it? Well, it was at a rate that's going down at negative 1.4%. That's your slope. And that slope is indicating that we're in for troubling times in particular. Now, what does GDP have to do with the recession? Well, usually recessions have been defined as consecutive quarters here of economic decline represented by the GDP and other monthly indicators with like rise in unemployment and all that sort of stuff. Now the definition is a little bit more broad. It's a little bit more tricky because whatever the NBER, National Bureau of Economic Research, they define as a significant decline in economic activity across the economy, which lasts more than a few months, visible in GDP, real income, employment, production, wholesale, retail sales. Which is interesting because it says more than a few months. However, GDP numbers come out only quarterly. So usually what happened is they would say back-to-back quarters of economic decline. So by the time Q2 2022 would be wrapped up here, we would get our numbers, and we would see, did we have back-to-back quarters? And if we did, we are now in a recession. What it tells you is that usually these are backward-looking indicators, meaning that by the time you realize you're in a recession, you've already been 2 quarters deep into it, so you're kind of 6 months behind. But usually we're slow rate of production, declining rate of production, and we got some high unemployment and inflation's kicking our butts. And those are all the cases. Those are also symbols of stagflation, which is what I think this recession people are talking about is going to be characterized by. That you're going to have high inflation, high unemployment, and low to negative productivity. But that's what we're facing right now. And I did a video last week talking about the unemployment, that while the job market is still pretty good, we're starting to see companies kind of scale back on their hiring. Some are doing layoffs. I know Amazon said that they're more interested in just making better products rather than hiring more people. Ford had some layoffs occur as well. Twitter is looking to lay off. That might be more business cases. Netflix is going into layoffs as well. So unemployment is going to be getting some news as well, but as of right now, we're focused on recession. So the GDP number comes out and people are worried. And how does that have anything to do with it? How do we know that that's going to be a great indication that we're in a recession? Well, I think the argument is that it's not a great indication. And there's this article here from the Macrodesiac, and I thought it was a great one. I subscribe to them. I don't work for them. I don't work for anyone, by the way. But usually I like the content that comes into my emails from them. I think they have some pretty easy to understand articles, straight to the point, and not sometimes a little bit longer reads, but they do a really good job of explaining things and providing more links or tweets to look at to get further information. So they had the same idea. The GDP fell at 1.4%. And I'm not going to read the whole article, but the things that I wanted to note that they brought up, which I thought were a great point that I was looking into as well, is they broke down how you get GDP. Well, it's private consumption added with gross private investment, added with government investment, added with government spending, and then you add in the difference between how much you exported subtracted by your imports. This is known as your trade balance. So what we see in these GDP numbers is that the characterization was that we consumed pretty well. Consumption was up 2.7%. Businesses still invested at plus 9.2%, and residential investment was at plus 2.1%. So all the factors that we saw that make up GDP went up, except that our trade balance was horrific. We had a negative 3.2% net exports contribution, meaning that we had a negative 3.2% trade imbalance. We imported way more than we exported. And that is shown heavily in the GDP numbers, which is skewing our GDP numbers, meaning that because we were importing so much, we're now looking at a possibility of a decline only because we weren't making as many things. And there could be a valid reason, you look at that and say, all right, the country isn't making enough to sustain their spending most likely. And that's a good, I think it's a decent way to look at it. It's definitely a point to make, but we've been in this situation before. In fact, we've been in this situation what feels like forever. If you take a look at the U.S. trade balance, we've always been negative. I mean, especially since the 1970s, and it's always gone worse. But like you take a look at 1990 to '08, if you were to say, well, how did the economy do? I mean, in particular, the markets themselves, there was a great time to be invested from 1990 to 2006. You did have you had spurts where you could definitely sell in 2000. You had a little bit of corrections, but overall, being in the markets between then was a great move, great indication. I think you most likely made money. If you were working, if you're advancing your career, it was a great time. You saw a lot of career advancement as well. And then if you keep a look at our trade imbalances overall, like we've been in high negative territory. And especially since, if we were to even look at this spike right here, '09 and after, we've always been in negative. We've, percent of GDP has been in a negative. We might have been hovering around, our percent changes weren't as bad. And this one was stark, but, you take a look at from '09 to 2012, we nearly doubled, well, not doubled, but like 66% increase in trade imbalance. But it was a great time, for the economy the economy was partially recovering at the time. Anybody who bought real estate at the time is thrilled right now. Anybody who was in the markets at those times, started buying at those times, are thrilled right now. So to simply look at our trade balance and indicate that right now, I think there's a lot of layers that go into it. The thing that is scary is that you take a look at those statistics as well, that we're investing a lot of money, we're consuming a lot of money, but we're not making enough to kind of be able to support that. And that's usually the case because the United States is much more of a country in which we spend money, we're a crediting nation, we take on debt, and we kind of, space it out as long as we can and do more financial games, so to say, to make our money rather than productivity. And eventually it's going to catch up. I think it's going, it's a huge indication of what is to come. But to simply look at it straight as only GDP and say that the GDP is what's going to be dictating our recession, I don't think that's the right way to go. But I think when you take a look at it and say, we're really starting to consume more than we produce, and we have to figure that out. That's going to be your biggest indication of how bad things can get, I believe, is by looking at that trade imbalance, looking at how bad things are going on the production to consumption rate, especially now that we are starting to shift policies from being accommodative in the economy to promoting growth, promoting taking more risks, promoting taking on debt to finance your future endeavors. We're shifting away from that to contracting, to maybe scaling down, to paying off those debts, to being much more cash-based, much more productivity-based, outcome-based. So that is something to worry about. That the GDP number itself I don't think is going to give us a great indication, but when you combine it with the fact of how much are we producing, consuming, and what is our monetary and fiscal policy saying, we're going to get a better indication. I think that indication right now is we're going to be looking at times that are tougher. I don't know if it's going to be as tough as a recession and all that, but it's going to be different than it was the past 13 years. Needless to say that strictly by looking at the GDP numbers, I think we're going to see a difference between what a recession feels like and what is a recession statistically or by definition, so to say. That we might be able to get back-to-back quarters of GDP negative growth or deceleration, but when you take a look at the overall job economy, when you take a look at people themselves, they're still going to be able to find work. That we might not be feeling it as bad as we did in 2008. We're definitely not going to be feeling it as bad as the Great Depression or anything like that. There's going to be differences. It's not going to be as clear-cut as our GDP numbers in Q2 of 2022 come out in, August or whenever. When those numbers come out and we can categorize whether we are in a recession or not and say that we are, it's not going to be so much that, okay, we're in one, people are really feeling the pain and all that. It's going to be a little different because people are able to obtain jobs, I think, and they're still going to be able to. All the while, it's going to be pretty expensive to purchase things. So the situation is a little different. We definitely say the greatest indication is going to be, in my idea, what the policies look like monetary and fiscally, how much money is the government going to be spending, where is the Federal Reserve going to be taking us and all that. But the whole point of this video is just to say that I think GDP might be leading you in a different direction than what you expect, especially if you just go outside and take a look. Prices are high, but jobs are still available, regardless of the fact that I mentioned there were layoffs coming. There's still jobs available, especially in high demand industries. And so we statistically might be categorized as in a recession, but the feelings of it might come later, regardless of what you see in the markets and what you see personally. So just keep in mind that there's going to be some disconnects between what the numbers are saying and what a lot of people might be feeling, just as there's always been, especially in the past 2 years. So with that, that's all I want to point out. If you're worried, okay, if you're worried about a recession, you're thinking like, what should I do to better hedge myself, protect myself, not in a market sense, but more so like, I don't want to get laid off, or I want to make sure I'm still being able to find a job and things in case things get tight. It's the same message I've been preaching, throughout since I've been making these videos, is that I think the best way for you as an individual to kind of hedge yourself from negative economic policies and all that is to really just gain skills for yourself. I work in the tech world. I mentioned before, we're always hiring. Tech is always hiring, regardless that the bigger tech companies might be doing layoffs, but there's always software companies that are looking to expand. Startups are always looking to get more people. But even at your current job, if you're working in a business, most likely those businesses are trying to do things quicker, automate things, find better insights and all that leading to tech. So learning tech, learning that would be something I would always advise to people, but that's only one industry. Quality will always win out in any industry. The best artists, the best musicians, the best athletes, the best programmers, the best restaurants, all those will always be fine. So putting in the time to become the best at whatever it is or gain some skills is where I would recommend. And like I said, it'll take 2 quarters. So we're 1 quarter in, which means you got about like 3 more months until we can officially declare ourselves anything. And you can accomplish a lot in 3 months, but there's a good chance you'll have probably about a year to really put some time in before things can get bad if we are going in that trajectory. So keep that in mind. If you guys are ever curious, like what I would recommend to learn in terms of the tech space, let me know. Leave some comments on that. I might do a video of like resources you can use to learn programming or anything like that to help you out. But that's all for today. Let me know if you have any questions or comments. I'll leave links to everything, including this macrodesiac article. And hope you all enjoy, and we'll be back later this week. It's going to be a big week because the Federal Reserve, the FOMC, is having their meeting, and most likely we're going to be seeing some shifts in the economic policies. So hope you all enjoy, and I'll be back later.